Quick introduction. I'm Beebe Saigal, your moderator for the session. I'm a principal in the Americas region at Economist Impact, offering a very rapid fire summary of our discussion today. So if we're serious about the energy transition, we need to be serious about how to fund or finance it as well. And that means rethinking who pays, how risk is shared, and what success or quality actually looks like. Public-private partnerships, fortunately, are no longer limited to just transportation infrastructure, so roads, rails, bridges, etc. They're quickly becoming the scaffolding of the clean energy future. Whether you look at microgrids in storm-prone communities or energy as a service in overlooked buildings, these partnerships are beginning to show promise and to show that innovation doesn't have to come at the cost of scale. Our panel today brings together leaders from a range of different areas of expertise, from finance to policy, philanthropy, and of course, individuals at the front lines of the clean energy innovation. Over the next few minutes, we hope to explore what's working, what needs fixing, and how we make PPPs a cornerstone of the energy transition, not just a side project. So without further ado, jumping into the meat of the panel discussion, the first area of discussion is around really unlocking energy investment through PPPs. So I guess the big question here is why public-private partnerships to fund the energy transition, and why now in particular? So Andrew, maybe you want to get us started with what markets, whether it's solar, storage, EV infrastructure, have proven the most successful for PPP-style financing in New York specifically, and what are some of the big bottlenecks you've seen?
Thank you. Thanks for the question. So maybe just to set some context, New York Green Bank is a division of NYSERDA, and it's our 12th year of operations. We have $1 billion of capital that we've been working with, and we're allocated from the state. So we haven't been engaging in traditional PPP model types of transactions, but in a way we are effectively acting in that capacity and have been for 12 years. So what we do is we work with private sector developers and sponsors to come in and fill funding gaps. And by doing so, create the precedent that hopefully then animates and catalyzes and drives in private sector capital. Quite often we do that with private capital alongside us in the same transaction on a pari passu basis. And we have very flexible capital to be able to fill funding gaps wherever they happen to be in the capital stack. Like maybe think of a Swiss Army knife model. You can really apply our capital almost anywhere where that funding gap persists. We're not competing with the private sector in any way at all. Happy to hand over a transaction to a willing lender. But where there isn't a willing lender and there is a use case that we think can and should be financeable in the private sector by private sector investors, we will step in and structure a transaction that we believe can be replicated and scaled. And by doing so, I think we're acting in that important PPP way, driving leadership, driving innovation, and hopefully demonstrating the viability of financing certain risk profiles and use cases that eventually can then be taken over and scaled more rapidly by the private sector.
Thanks. And Petya, from the more sort of institutional investor perspective, how do you view the energy transition as an opportunity, particularly when paired with public capital?
So maybe I'll start also with providing some context about what we do as an institution. We are the third largest pension fund. If you can't hear me, I can see that they're looking at it.
Maybe, Petya, maybe we come back to you when they let us know that it's on, but
there we go.
Yeah. Emergency.
Good afternoon again. So I was trying to provide some context around what we do as well, so that as I comment on public-private partnerships, you can see our role. We are a public pension plan. We are the third largest in the U.S., representing around 280 to 290 billion of assets under management for everyone who is employed in New York City. And we are an institutional investor, so we invest through funds, and that's a key point because we don't directly invest in partnerships. So the way we invest in energy transition and the way we see the opportunity is through the returns that we are receiving through that. And we all know about the opportunity set. The only difference is how many hundreds of trillions are coming down the line to invest. And the big question is, what is investable right now? For us, we could invest talking about risk and return through the infrastructure lens, where we are going to get lower return, probably relative to private equity and venture, but still very good risk-adjusted return. And in terms of P3s, that is an interesting question. The classical ones coming from the UK, then a lot of them in Canada, actually haven't taken off in the US, even in the traditional sense of transportation. But similar to New York Green Bank, we are investing a lot through these funds. There are a lot of partnerships, a lot of investment in traditional renewables, or we heard about storage. We see a lot more being done in carbon capture. So we are supporting investments. And if you look at our portfolio, we are around 25% invested on the infrastructure side in this.
I think just to help us frame the urgency a little more, I guess, as we enter the hurricane season as well, Elizabeth, I know the foundation is doing a lot of wonderful work around some of your partnerships, the ones in Puerto Rico and a few others as well. What are the defining factors? What are the success factors here?
Yeah. Go old school again. Okay. Hi, it's nice to meet everyone, and thanks for the question. My name is Liz Yee, and I lead the programs at the Rockefeller Foundation. And just a little context on us: we are a 112-year-old foundation created by John D. Rockefeller with a mandate to focus on the well-being of humanity. And there is no greater challenge right now in doing that than the environment that we live in. And so we are focused on a few areas. One is food systems transformation. The other is climate and health. And the third is energy, which I think is relevant to the topic today. And you asked about the challenge of hurricane season. And so that's why I wanted to share with you some of the work that we've been doing in Puerto Rico, because we're just about to hit a very challenging hurricane season in that community. And what what we feel our capital is best used for, is to help support the new ideas and innovations, and ideally to crowd in other private sector capital, other actors into the space. And so if I take you back to 2017 and Hurricane Maria, as you probably remember, it devastated the island of Puerto Rico. It was 100 days of power outage for that community, the longest blackout in U.S. history. Puerto Ricans right now pay 47% more for their power than any other community in the U.S. So there's also a huge equity issue. And for those who might have just recently been in Puerto Rico in April, about 1.4 million people just lost power for 2 to 3 days. So there's no doubt in our minds that we need to do something to strengthen the energy grid and energy access for those communities. And so what we did is we took a look at a study coming out 2019, which came out of the Hurricane Maria. There were about 97 different suggestions from local Puerto Ricans on things that could be done to strengthen the island to make sure that it was more resilient to hurricanes. And so we picked one, which was energy. And we did that because we created something in partnership with the IKEA Foundation and Bezos Earth Fund called the Global Energy Alliance for People and Planet. And so what GAP did was it actually made a $5 million grant to help support energy reliability in communities in Puerto Rico. and it partnered with the local community foundation so that it had the trust of the local communities and it represented what the local communities needed. And Banco Popular, for those who aren't familiar, local Puerto Rican bank. And from there, we were able to actually start lending to communities and actually critical facilities on the island, which otherwise were too small to get loans or too big to qualify for free solar, and was a gap in the market. But these critical facilities are important for continuing life and resilience on that island. And so I'm proud to say that we've been able to mobilize about $15 million of loans out and reach about 75 different communities. So to be able to actually ensure that they have access to reliable solar. And I think that's how we build those partnerships. It's through community, it's through existing institutions, and it's using our capital in a way that creates the incentives for other people to come in.
So I think there's broad consensus in the room and across the panel that there's a massive gap if you look at just public investment in terms of addressing this clean energy gap. Some estimates say that it's in excess of about $2 trillion per year even. PPPs, proper well-defined PPPs from, build, operate, transfer modalities across different infrastructure sectors. They are stepping in a lot of developing regions, Latin America and Caribbean, facilitated by IDB, or in Africa, facilitated by, in a big way, the African Development Bank. Those are well defined. You have some public support. You have private investment coming in as well and starting to address that critical infrastructure investment gap. What is the big challenge in the United States context that hasn't really allowed for this type of arrangement to take off? I guess. Open question. Anyone, please. Yeah.
Well, I'd be happy to. I think you can hear me. I think that those examples overseas are large, very large infrastructure projects that are almost sovereign in nature. And while New York State is obviously a very large economy, a lot of the clean energy investment that we're looking at are smaller scale. And so instead of formal PPP structures where there's a joint ownership in a vehicle by public sector, by the private sector, et cetera, they're sort of more virtual. So we have state actors that are providing support. We have NYSERDA, let me give an example, community solar. So that launched about 10 years ago in New York State. And we're not a top 5 solar resource in the country, but we've got the most robust community solar market in the country. And why is that? Because what we have is the support across the state of various actors that are acting effectively in taking on roles that are similar to the roles you would see in a formal PPP. You have Empire Development, ESD, Empire State Development, providing incentives where there's an employment potential. You have NYSERDA providing programmatic support to de-risk the business model, to provide capital to support the business model. You have New York Green Bank lending alongside that, demonstrating that the project is debt financeable by the private sector. You have a very robust permitting and regulatory through DEC that understands how to efficiently get permitting done in clean energy sectors. If you have that infrastructure in place, like you have in New York State, even a state that isn't a top 5 solar resource state can create the environment that leads to an acceleration in a particular asset class. We saw that in community solar. We're now focused on clean transportation, building electrification, and energy storage in New York State. And obviously there are other technologies that hopefully will be, continuing to mature over the next 5 years that may change those top 3 priorities. But those are our top 3 today. And we're looking to replicate what we've done in community solar with those 3 through that more virtual model.
Yeah, Thank you for saying that. I agree completely that there's real value coming from the states, but I think I would also reject the premise of the question. VJ told me I was only allowed to come back twice if I spicy, so I'm trying. But the last couple of days, I mean, in some ways have been fairly depressing. Some of the panels this morning, I think there's a lot of navel gazing going on about what's happening in Washington. And I think it is telling that we have a large panel here, but there's no one from DC. And that was probably not for a lack of trying. So, I still think it's valid. I don't think we're giving ourselves enough credit. And I would tell a story from a long time ago. In 2003, I was a solar entrepreneur. My company was the first venture-backed solar technology company in the Bay Area, at least of the modern era. And I went to a solar finance conference. It was the first solar finance conference in the country. It was a big deal. It was in San Diego at a fancy conference center, maybe not so fancy. It was like a Homewood Suites kind of thing. But still, it was like everyone was going to be there, and I was excited, and maybe somebody would actually finance one of my little projects. And I got there, and the room was about a third of the size of this room, and it was not even entirely full. And I sat down, and that was it. That was the whole conference, the U.S. Solar Finance Conference, and that was the whole industry in that room. And I was sitting next to a young banker in a suit, and there was a guy up at the podium pounding the table and getting everyone really riled up about this. And he said, "We got to stop talking about kilowatts and start talking about megawatts." And the guy next to me said, "I don't know what a megawatt is, but I like this guy." and that person, the guy on stage was Mike Eckhart, who was an industry pioneer back then. But really, like no one knew what a megawatt was. We just were getting started. And he later became vice chair of Citibank because of his work leading us in this brave new direction. And now we are definitely not talking about kilowatts. We're barely talking about megawatts. We're only talking about gigawatts. And we're talking about $2 trillion gaps, but we are spending $2 trillion a year in the private sector to make this a reality. And a lot of people are making a lot of money. I'm a venture capitalist, and we only do early stage investing. And after 15 years in the solar industry, I shifted over to venture, and I told my partners, we're not going to do anything in solar or wind because it's done. It's infrastructure now. It's like a yield co-product. It's just not something that we can take a lot of risk on because you don't need a lot of risk capital. So I think we have come a very long way, and so much of it is because of public-private partnerships. And a big chunk of that was tax credits and tax policy that were some of the sort of heavier handed, but like also simple, hey, we'll just pay a third of the bill kinds of deals. And when the federal government, a lot of progressives are sort of, very federalist people, they like, this central control until we don't. And then we say, we're anti-federalists and we love the states. And then the states come and take over and get it done. And a lot of nonprofits and other organizations come. So I just want to say that I think we actually have made tremendous progress, and there is a patchwork of these kinds of partnerships that help us along the way. But business is now very much the center of it. It's one of the biggest pieces.
Go ahead.
We'll see if can you hear me okay? Okay. I guess I'm the private operating company guy on the panel. I'm going to make a couple comments. So I founded Butterfly back in, I think I founded the model in 2016 or 17, and we're probably up to about $1 billion raised. I'm going to make some overarching comments that I think are worthy of thinking. And the reason we founded the company, and I'll give it to you, it bothered me that we generally waste about 30% of what we use. And I did the quick math. If we got rid of the 30% and not spent money for solar to power something we don't need on top of it, which gets like a double problem, we might solve most of the demand supply challenges we have today. And I asked myself, why don't we solve that problem? And for me, it came down to one important aspect, the market, the industry. And I'll be a little critical if you don't mind. I believe it or not, I don't come from the energy industry, which gives me maybe more freedom. We have a project-based mentality in the energy space. Everything is. The way we raise capital, the way we deploy capital. That means every project gets defined on its own cost-benefit analysis, which drives a massive long sales cycle and a massive amount of friction. In addition, we have a utility billing system that's so hard to read, a poor CFO cannot figure out IRR and return, which lowers confidence, which is why nothing happens quick enough. So and this is less about Butterfly, more the market, we built a model that focuses more on aggregating a portfolio of things for just simply a better outcome for a building, and we pay for everything. We created a unique technology in the billing system to have all the answers come out the bottom automatically. That way, when we raise capital, we raise it for a market. And a customer has no friction to make a decision, because if we're going to have a big impact on the world, we have to get to scale. And if we do everything that gets decided on a single decision, it's going to take too long. So you change the rules of the game. So one thing I would like to say is, if you take a portfolio of energy efficient components, frankly, including solar and storage, it actually can make a lot of money for everybody over a 10 to 15 year basis. You do the math, we've done it a lot. This is a money-making venture. This is a capitalistic, using capitalism as a weapon to solve a problem is doable. And we're doing that today. And we've raised $1 billion and built a $250 million company in less than 6 years, because it's good for everybody, the customer, the environment, the utility, everybody. And people can make money doing it. Nothing wrong with that picture. Pull 30% out of the use case today, and I think we solve an awful lot of problems on our grid right now that are happening. And we have all the technology to get that done. We just have to move a lot quicker.
I think having got quite a lot of perspectives, shifting this back to the kind of the institutional investor line of questioning, one of the big challenges is actually unlocking that private institutional investment, and institutional investors are seeing a lot of risks, whether it's political, of course, today, financial, regulatory, so on and so forth. So I think, Petya, back to you to get that perspective a little more. What are the biggest challenges to unlocking that investment?
That's a great question, and a question that we ask ourselves every day as we look to make new investments. And as we think about energy transition, it's a huge space, right? As we just talked about, like different risk return for different deals. So this is the key for us to understand when we see an investment, where is the risk and how much are we getting paid for that risk. And we also talked about solar and wind, and I think these technologies are very well understood. As you mentioned, the returns are different now. It's a much more mature sector. So we understand that risk as well, but maybe it's not enough what we get paid there. I must say right now it's different. Post the new administration, the landscape has changed, and even in operating renewables, we see good risk-adjusted returns. And then you go up the risk spectrum, and the picture gets very blurry. I mentioned carbon capture. We see a variety of other types of energy transition investments. And then we need to ask ourselves, is this private equity or is this infrastructure more mature? Again, risk-adjusted returns. And that is a difficult question. It may seem rather trivial, but these are not spaces well understood. There is not enough track record as we look both at the underlying investments and the fund managers that we invest through. So I would say this is the core of our challenge today, understanding the risk and if we are getting paid enough to take that risk.
But there is there's a big gap between real assets or these sort of infrastructure assets and venture capital. And in between, there's a progression of later and later stage venture or later and later stage risk capital. But there too, I think there is a massive new pool of capital that's shown up in the last 10 years. And so our fund is now 11 years in. We have 1.1 billion under management. And that makes us sort of small compared to a lot of the later stage capital that's specifically only focused on climate. We're focused on healthcare as well as climate. But in the climate space, TPG and Wellington and, KKR, Decarb Partners, Temasek, GIC, a lot of sovereigns who want to do direct investing. Those things add up to, easily 50 to $75 billion worth of late stage capital. There still may be some gaps between that and when you can say, let's go build a bunch of project finance power plants and together with other public-private partnerships. But I think it's important to note that a massive amount of capital has shown up for that later stage risk stage as well.
We are one of the recipients of Partners Group, very large, been a great partner. If I could make a comment, I think there's an emerging asset class that the folks who finance should look closer at. It's the spend itself. If you take a 10-year stream of flow, the pattern of energy use for most businesses is consistent, predictable, and will not go away unless the company's out of business. If you take a 10, 15-year value of that, you have an asset class that you can get capital. And if you put a science around driving benefit from that, the money folks can make a good amount of money, and you can afford to essentially upgrade the entire facility to drive and capture that benefit. So we've actually successfully been able to drive funding against that asset class because we made it a science where, a lender can look at that and say, I now see the consistent pattern of benefit. I'll lend against that, which I think unleashes the ability to have a lot of upfront capital to solve this problem very quickly, but you have to make a science out of it. So all of you that have buildings and facilities, you're sitting on an asset class. If you put some science around it, which really unleashes a tremendous amount of capital to do the things we need to get done.
I think connecting the discussion about, say, scale and the US context, where there is a bit of a lack of, I'd say, federal clarity. I guess, again, an open question to all of you here. What is the role that states can play as it relates to, driving this public-private collaboration around energy specifically?
Well,
anyone.
Look, I think that was discussed in the last panel, and I agree with that. Targeted investments, good public policy, and real incentives, and including lending support from green banks. We're not the only green bank in the country. You all work with Connecticut very closely.
Yep, absolutely, they've been terrific.
And so this model can work across the country. There had been, as part of the IRA, the opportunity to fund up to $27 billion into this sort of green bank type space through 3 separate competitions. That's currently somewhat frozen. So we'll see how that all plays out. But nonetheless, the model, has been working across different states. Not all states have had a green bank for as long as New York has. But when you pair all that together, a state can do a lot. Someone made the analogy of sort of a balloon. The New York steps up as much as it possibly can, as the need necessitates to flex into the opportunity when there's headwinds at the federal level. It's not going to be a perfect replication. There's always inefficiencies in terms of how quickly that step up can take place. And quite frankly, this is probably the most unprecedented time we have in terms of uncertainty around a whole variety of things above and beyond federal policy. Supply chain issues and, cost issues in terms of inflation and tariffs and everything else. So, a lot of even the large utility scale type opportunities, I think folks are trying to understand, because things are evolving so quickly, how to risk assess, let alone those things that are subscale and that aren't going to get the attention of TPG and KKR, that are small, that you need to really try to convince some of the regional banks to take a view on, because their sweet spot's more in the $5 to $30 million range. So that's, it's a complicated space. You need states like Connecticut, like New York, like California, and others that are pulling together to try to create, the type of environment that can continue to accelerate the transition, even in the context of all of this uncertainty.
I would just three quick things. One that costs no money, one that costs some money, and one that should make some money. The first is just lower regulation. I come from California, where we do a lot of energy development. We're an investor in a geothermal company based in Utah, and there's a lot of geothermal resource in California, and they won't touch California because of our environmental requirements through permitting that just make it impossible. The governor and a lot of people are looking at lowering those regulations. So in general, finding ways to streamline regulation, I think, can be a huge boon. Shouldn't have to cost too much to do that. I think states can make money by doing what New York does with the Treasury and what California and others will do with pension funds to invest in venture funds, but in all sorts of assets in a very directed way, an intentional way. And New Mexico actually does this with their own sovereign fund. There are two states that have sovereign funds, Alaska and New Mexico, and they direct a lot of that money toward this effort because they think it's a great way to make money, because they see, because they have an underwriting thesis. And then I think the last is direct real subsidies. And I'll just give the example of California, talking about these new sort of cutting edge technologies and even technologies that are great ideas like what you've created, but are not getting enough support broadly. In California, in the early days of the solar industry, there was a really, really intelligent policy that just said the more you all install, the lower the subsidy is going to get. And it was spelled out very, very clearly. It was volumetric. So with each increment of megawatts, the subsidy went down, and incentivized all of us to sell as quickly as possible so we could stay at the upper increment and then lower cost and lower cost. And if that had been used in Germany and Spain and other places, they would have saved billions of dollars in a correctly designed subsidy. That same model could work for batteries. It can work for software as a service to make grid balancing work better. There's a lot of ways to sort of implement that tool. So there are places to spend money and maybe places to make money.
We should have time for a question from the audience if there's any for the panel. Yeah, go ahead.
Hi, I'm Matthew from MSCI Research, and would love to hear, if we're in a persistent high interest rate environment for the next couple of years, what challenges that presents, but also what opportunities would you see in this space specifically? Thank you.
I'll tackle that. The notion of securitization in at least our world is when you have a big pool of customers and the credit ratings are mature enough. We actually are not there yet. So we're paying, I'm calling a little bit higher. It doesn't bother me at all. We're in it for the long term. And as time goes on, I believe the surety of outcomes and the more scientific measurement of those outcomes appeal to more and more people. I think money becomes generally available. It does not hurt to partner with the green banks. We've done that in Connecticut, worked quite closely with them. They do present a layer of funding that does help that model, especially for the private lenders. So mixing public and private together, I think, has a pretty positive impact if you can pull that off. But we haven't had an impact on the slowdown. But again, we have a long-term perspective. You can't look at this as a 1-2 year haul.
Okay. My take on that would be that for new projects, you're going to see these costs transferred through. So energy is needed. We are short right now. Energy demand is expected to go up tremendously. Again, this is going to be transferred. And the key would be, what is the contract structure? We talked about the risk allocation today, how risks are allocated. But I think for projects that are going to be built, that is the positive, right? For the project that needed to refinance, and they borrowed under the prior macroeconomic regime, that would be more challenging.
Well, that actually brings us to the end of this discussion. Thank you so much to the speakers. Thank you to the audience for staying engaged. And just want to announce that we now have an afternoon break for about 30 minutes time. And if anyone's interested, there is also a book signing outside the room by Adam Met, who is a musician, academic, and a climate activist. Thank you.